Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights, with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
Welcome back to ETF Market Insights. I'm your host, Erin Allen with BMO ETFs. On today's episode, we're going to be reviewing an important topic that can really significantly impact your investment strategy and tax planning, and that is tax loss selling, or tax loss harvesting, as it's sometimes called. So as we approach year end, a lot of investors are thinking about tax efficiency within their portfolio. So we wanted to dig into this topic further and how ETFs can be an effective tool to implement this strategy, as well as some changes that you might want to consider given what happened with the federal budget this year. Before we do get started, a quick reminder that we're not providing any investment advice or tax advice today. Today's all about education and information. And as always, with anything tax related, it's always best to consult with a tax expert about your unique situation before taking any action. So today I'm joined by John Waters. John's been on the channel before, but he is BMO Private Wealth's VP and Director of Tax Consulting Services. He's got more than 2 decades of tax planning experiences, and he's a trusted resource for many. He's often recognized as a subject matter expert, a spokesperson on tax and estate planning for different news outlets and media publications. And he's also consulted on developing Canada's very own tax legislation. I'm also joined by Andrew Vachon, VP of Product here at BMO ETFs. I've worked with Andrew for years now, and he's a great resource on all things ETFs. So welcome. Thanks for joining me, John and Andrew. Let's dive right in. John, I'm hoping you can walk us through what we mean when we talk about tax loss harvesting. What is this strategy really?
Yeah, it's a common tax planning strategy that we look to undertake at this time of the year. Typically, you're looking back at the history of your capital gains and losses year to date, and to the extent that you have capital gains realized, and these of course are in your non-registered taxable accounts, you would sort of do an accounting of your gains and losses realized year to date. And to the extent that you're in a net gain position, you might consider triggering some accrued capital losses to offset those gains realized year to date, to reduce that tax bill that you would otherwise have on those capital gains. Or alternatively, if you'd be in an overall net capital loss position by triggering additional losses, you could potentially carry back those net losses to a prior year, up to 3 years, and recover any tax that you would have paid on the capital gains realized in those 3 prior years. So, ideally, your investment mandate should guide the decision. So you're looking at securities with accrued losses that you would otherwise intend to sell in the short term. And you've also got to take into account something called a superficial loss rule. So you can't, if you, oftentimes when we sell a security, we might like the long-term prognosis on that stock. So we might want to get right back into it, but there's some tax rules that will prevent you from reacquiring that security and within or immediately or within 30 days that would deny that loss if you reacquire that security. So you have to sit on the sidelines for at least 30 days. But that's where ETFs come into play, because it might be a way of sort of mimicking the performance of that individual security by buying an ETF that might track a similar market. So certainly some opportunities there.
For sure. So beware of those superficial losses, and we'll get into how ETFs can help with that for sure. You were on the channel, I guess it was six months or so ago now, unpacking the federal budget. And I'm wondering, are there any important considerations this year in 2024, given the changes to the capital gains inclusion rate?
Absolutely. 2024 was certainly a very significant year for tax changes. the most notable one is the capital gains inclusion rate. So that is effective as of June 25th of this year. Now, it's not been formally legislated, but by all indications that we're expecting that will be formally enacted within the coming months. And what's changed is that there's an increase in the capital gains inclusion rate from 50% to 2/3, effective June 25th, 2024. And that would be $1 for capital gains realized within a trust or a corporation. And for individuals that have realized over $250,000 of capital gains, either in the period of June 25th to December 31, 2024, or going forward annually in 2025 and thereafter. So for most individuals, if they keep their annual capital gains below that $250,000 threshold, there is no change. It would still be that 50% inclusion rate. But certainly for large investors and certainly for any corporations or trusts that may be engaging in tax loss selling in 2024, it's definitely a consideration, and there's some impacts to the calculation, and any tax loss selling strategy would be a bit more nuanced this year. In effect, you'd have to kind of separate the year into pre and post June 25th and calculate your gains in those individual periods separately, and then sort of combine them. So any individual that's over that $250,000 threshold in capital gains, or any corporation or trust doing this tax loss selling strategy, it would be best to work with their accountant and take into account those nuances. And there may be some strategic application of capital losses to access that 2/3 rate where that applies.
Okay, good. So maybe a bit more of a tricky year for some when it comes to tax filings. What about timelines and important dates to keep in mind for investors when considering this strategy? Anything to note there?
Yeah, the main consideration would be to make sure that this transaction, this loss sale, is effective for tax purposes in 2024. And the settlement date is what's relevant for tax purposes. Now, there was also a change in the settlement date. It's now typically a 1-day settlement, a T+1. So that buys us a little bit more time. So the main date to be focused on here is Monday, December 30th. So for most transactions that will settle in that 1 day, that would be the last day to engage in a tax loss selling strategy, so that it in fact settles before the end of the calendar year.
I had forgotten about that T+1 change when I was looking at the dates, and I was just surprised by the December 30th date as the deadline there. So that's good to know. Got a little bit more time this year.
A little bit, yeah.
Can you walk us through just a simple step-by-step illustration of how a tax loss selling strategy works?
Sure. So let's say we've got a stock, say we'll call it XYZ, that was sold earlier in the year at a 20% gain. So let's say it had a cost base of $100, is up 20%, trading at $120 when we sold it, so a $20 capital gain. Now, if we look at our portfolio again across our non-registered taxable accounts, if we have a security, say ABC, that is trading at 20% below what we purchased it at. So again, let's assume a $100 cost base. Let's say it's trading at below that at $80, 20% down. So if we were to engage in a tax loss selling strategy by selling that stock that has an accrued loss, again, $80 proceeds, $100 cost base, $20 capital loss, that could offset that $20 capital gain that we realized earlier in the year. So the idea here is that if we did nothing, we're going to pay tax on that capital gain. If we engage in this tax loss selling strategy to trigger some capital losses, we can offset that capital gain, have a net capital gain of $0, and avoid that tax. So then we've got proceeds from the sale of the security, and we're thinking about reinvesting that. Well, unfortunately, we can't go right back into that same security because of the superficial loss rules that I mentioned earlier. So we might look at a similar security, or perhaps an ETF that would track the index for that market, or that industry that that the stock ABC was sold. So ETFs can be great to assist with the tax loss selling, can help you share in that upside if that stock or that industry does recover, and also avoid those superficial loss rules.
Perfect. Thank you. And for our viewers, if you're not already on our newsletter, we're going to be sending around a nice white paper on this as well. So if you're like me and you need to hear things different, hear it, read it and all that, then sign up for our newsletter and you'll get that in your inbox on Tuesday as well. And you can do that on etfmarketinsights.com. Thanks for that, John. That's great. Andrew, I want to bring you into the discussion here. Being in our in-house ETF guru here, walk us through why ETFs are such an effective tool for this strategy.
Sure. Yeah. Thanks, Erin. So when you look at the ETF universe, now more than ever, there's a lot more solutions available for clients at their fingertips to accommodate their needs. When you have ETFs that track specific sectors, factors, indices, and different asset classes, really the list goes on and on. The evolution of ETFs have been a fabulous thing. But for tax loss selling purposes, using ETFs is a great way to avoid sitting on the sidelines, as John mentioned, for 30 plus days and staying invested to take advantage of any potential upside that you might see in the market. So once you determine the securities that you want to sell at, say, a net loss to offset any future capital gains, you can start to really think of the plan of attack. A good way of doing this would be looking at the correlation between your particular security and the broad market that you might be looking at, like the S&P 500. You might want to consider the BMO S&P 500 index ETF for that, if it has a high correlation to, say, I don't know, Apple or whatever the case. Having said that, you have the ability to become more narrow, so you can attack a specific sector that you might be holding a security in as well. So that's always great. But a lot of people look at ETFs and realize quickly that they're fantastic low cost solutions. So for the fee cautious investor, switching over to an ETF for the short period of time isn't necessarily a bad thing. I mean, some of our ETFs are as low as 5 basis points. They're fairly inexpensive. You also get the diversification aspect as well. So if you sold a particular utilities stock that might have been underperforming, and you don't want to take the risk of being company specific, and you might have the fear of being wrong with that particular security, you get that instant diversification as well by choosing an ETF for that solution. Transparency is also a beautiful thing here, because you can see all the holdings within the ETFs. If you have a particular security that you're eyeing, it might even be in that particular ETF, a small holding or whatever the case. So let's not forget too that ETFs do trade like stocks. So you do have that intraday trading, so you can purchase and redeem ETFs in the same day, which is great.
For sure. And one tool, we recently launched our stock replacement tool on the website. So I think that's a great tool for this season as well. If you have a name that you're looking to get rid of, you can plug it into the stock replacement tool, and it'll show you the ETFs in Canada that have the highest exposure there. If it is that you still want to keep that exposure, you can see what ETFs have the greatest exposure to that stock. So that's a good handy tool as well. We've been getting some good feedback on that tool. What about this year in 2024, Andrew, in Canada, the US? What are some of the tax loss selling opportunities you're seeing?
Well, the markets have been up quite a bit this year, which is great. I mean, can't necessarily complain about that. It could have made it challenging for you to find those losers if you do fall within that category of having your whole portfolio being up. If so, good on you. But for tax loss selling purposes, you may want to have those losers to offset any future capital gains in your non-registered account. And BMO has created a couple of charts which lists stocks that are currently down year to date. This chart is just a guide, really. What you want to be doing is looking at your portfolio and finding the holdings that are down within, say, the last 3 years that you've purchased. So you want to look at the current price of that security versus the purchase price or adjusted book value. It's important to keep that in mind, since we don't necessarily know your entry point. So Having said that, here's a few stocks that are widely held by investors this year that are down right now. It looks like there's some opportunities in the dividend space specifically, where some major dividend paying companies such as Rogers Communications and BCE in Canada are down. So a good idea could be to sell those and pick up something like a BMO Canadian Dividend ETF, ZDV. If you look at south of the border as well, in the U.S., there's a few companies that are down year to date, such as Intel. You might want to consider just going more broad there, holding something like the BMO Nasdaq 100 Index ETF, ZNQ. How about Dollar Tree? Dollar Tree has been down quite a bit this year. Perhaps you may want to consider something a little bit more defensive, like a ZLU, which is the BMO Low Volatility U.S. Equity Index ETF. U.S. Equity ETF. I won't go into all of them. However, depending on when you purchase some of these holdings, there may be some opportunities out there for tax loss harvesting here.
Has been a very strong year in markets, so I'm glad you uncovered a few for us there. We've talked about how ETFs are really effective for tax loss selling, but what are some important considerations investors should keep in mind when using ETFs for this strategy?
Yeah, I mean, as you mentioned, it is important to always do your due diligence whenever it comes to tax planning. Having the perspective of a tax professional can go a long way. So always consult with a tax professional before implementing any type of tax loss harvesting strategy. A couple of things that I do want to point out here is that first, if you have an ETF and you're looking to do a tax loss selling strategy with another ETF, you want to make sure that it doesn't track the same index. So CRA won't recognize this. An example would be switching from something like a BMO S&P 500 index ETF ZSP to another S&P 500 ETF provider from a different provider. So you want to make sure that that's not the case. Again, they won't recognize that. And second, you always want to consider potential year-end distributions for the ETF you switch into as well. So how much tax you could be paying from that year-end distribution is really important.
Speaking of year-end distributions, and just to cap things off as we head into year-end, maybe you can give us sort of a timeline on, if we're thinking about investors switching into an ETF and we want to avoid those big year-end distributions, when do the estimates come out? When do the finals come out? And then when are the tax slips coming out in the new year? Give us the whole picture there.
Yeah, so ETFs that have any capital gains, they're typically distributed annually in December, and investors will receive them via reinvested distributions. And yes, there are year-end distribution estimates, which are typically announced from ETF providers via press release around mid-November or so. These are simply just mock distributions that give us a guideline as to what we can expect during year end. The final distributions are announced on the last declaration date of the year, which for BMO is December 18th, 2024. So unit holders of record at close of business on December 30th, 2024 will receive the 2024 annual reinvested distributions. So investors who receive these distributions throughout the calendar year will receive information on tax treatment of the distributions at the end of February, in and around the end of February of 2025. People will be getting the tax slips. So regarding the tax slips, ETF providers don't have insight into the unit holders. So investors will receive the T3s from their respective brokerages. And the ETF providers post these factors to CDS, which is the Clearing Depository Services, Inc., generally around mid-February or so. The dealer will then prepare the tax slips for clients and the cost adjustments then thereafter.
Perfect. Thanks, Andrew. So the estimates are coming out probably in the next couple of weeks. So keep an eye out for those. If you are thinking of switching into one, it may be prudent to wait till you know what to expect around the end of the year before doing so. Thank you so much. Thanks, John. And thanks, Andrew, for joining. It was a great overview of important strategy when it comes to tax planning. Thanks to our viewers for tuning in. And remember, the best way that you can support this channel is to like and subscribe and share it with your friends so that we can keep doing what we love doing. Next week, we're going to be diving a little bit deeper into alternative strategies. We did talk about this a couple weeks ago, but we're going to be looking at and introducing what's known as the long-short strategy. So hopefully you can tune in next week. It's going to be a great show. That's all for this week, and we'll see you next time. Bye for now.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.